Hi everyone, this is Dr. Nitin Choda, and in this training video, I'm going to talk to you about the end of real estate as we know it. Everything we've traditionally thought about real estate is fundamentally changing because of this crisis. I'm going to cover four things in this training video. The first is this pandemic is causing more and more mortgage delays, more and more rent delays, and more forbearances. We're going to go over some statistics that just came in as May rents are due. The second, it's becoming harder and harder to get a home equity line of credit. It used to be the easiest thing in the world. All you do is tap into the equity of your house and you have an instant source of cash and an instant piggy bank, if you will, and that's now changing quickly. We've never seen this before in the history of our country. The third thing is that the mortgage bailout program is continuing to grow as more and more people are facing relief. And the fourth thing is this pandemic is actually resulting in a small shift in behavior, and it's yet to be seen if that'll escalate into a bigger shift, and people are moving away from urban areas, away from densely populated areas, into new constructions and into more suburban homes. So we'll go over all of these things in this training video, so let's get started. So at the time I'm recording this video training in the first week of May, roughly 3.8 million homeowners are in a mortgage forbearance program. This represents 7.3% of all mortgages. So that represents $841 billion in unpaid capital. Now, if we look at what's happening this year and what happened last year, by the end of April, we're talking about May rents, 91.5% of rents came in according to one statistic of professionally managed buildings. And at the same time last year, over 95% of rents had come in. So what's happened is rents were coming in April. Now rents are starting to not come in as quickly in May, and that's the trend that's actually beginning right now, which is concerning for the whole financial system, which is concerning for renters, it's concerning for landlords, and it's concerning for banks. In fact, in an article in the Washington Post, the headline reads, "The housing market faces its next crisis as May rent and mortgages come due." The article says millions of homeowners and renters are already behind on payments in the economic collapse, and the jobless ranks are growing. What's happening across the country is that the housing and rental market has fallen into a severe crisis because as May rents come due, it's becoming harder and harder for people to actually pay those rents. In fact, what's going to happen is I foresee essentially a battle between the homeowners and renters on one side and the landlords and mortgage companies on the other side and the banks on the other side, because if the renter is unable to make their payment, that makes it harder for the landlord to make the payment to the mortgage company or the lender. If the lender cannot get the payment, then the bank starts to suffer financially, and the bank can't give loans and the bank can't extend credit, which then affects other parts of the economy. So essentially what we're starting to see now again is a battle between the homeowners and the renters on one side, who simply can't afford to pay because their income has dried up and they've started to dip into their savings. They haven't gotten their stimulus checks. And on the other hand, you have the landlords who need those funds in order to pay the mortgages to the mortgage companies, to the lenders, and then the lender in turn, which is usually affiliated with the bank, which usually is a bank, says, well, if we're not getting our funds, we don't have any funds to give out, we can't extend credit, we can't give loans, and we can't remain solvent. So it creates a crisis that's gradually becoming worse and worse. And that number that I mentioned earlier, the 3.8 million homeowners seeking forbearance either through government programs or private programs, that number is likely to get worse because the true unemployment numbers will actually get worse and worse. The reason is there are a lot of individuals who essentially put their hands up and said, I'm not applying for unemployment because it's so overwhelming, I can't get through to it. So the actual unemployment numbers will be worse. So the actual numbers for those who seek forbearance is actually going to get worse and worse, which in turn will escalate the pressure that the mortgage owners as well as the renters feel on one hand, and that the landlords and the banks feel on the other hand. And rent collections in May are going to be lower than rent collections in April, and who knows what's going to happen to rent collections in June. Because most individuals are finding it so hard to pay rent, the hashtag cancel rent has been trending online. And on top of that, there are federal and state eviction moratoriums that prevent an individual from getting evicted, but they only last a few months. So at the end of those few months, the renter is going to be expected to pay back the rent that they missed over several months. So it really creates a situation that is unsustainable in the long term for most individuals who are unable to return to work. And this entire situation is disproportionately affecting some individuals, because those who are in a lower income bracket are going to find it much, much harder to pay rent because they don't have any savings. So individuals in a lower income bracket are going to struggle to pay their rent in May, and it might even get much worse in June. I've talked about the wealth disparity between the rich and the poor in other training videos, so you can check those out. But nothing speaks more clearly to this wealth disparity than this that you see on your screen right here. This whole situation has not stopped some wealthy homeowners from listing their luxury properties. In fact, this property that you see right here is a property on Forest Knoll Drive in Los Angeles that's going to come on the market for $32 million this month. Can you believe that? It shows you the tremendous wealth disparity between the rich and the poor in our country. Now, if you're a homeowner and you're watching this training video, and if you haven't yet gotten a home equity line of credit, now might be the time to apply for it before it runs out. Most of us consider home equity lines of credit as an emergency funding option in case we need to tap into that money for a rainy day, because we're actually tapping into the equity of our home, money that we've already paid off. The problem is big lenders like JP Morgan Chase and Wells Fargo are actually halting applications for home equity lines of credit. So what this means is the banks are actually anticipating that there'll be a rush for funds, and what they're doing is they're halting applications. So this means the home equity line of credit, which was typically and which is typically our rainy day money, which is typically a fund that you tap into for emergencies, may no longer be available. So it's essentially bad news for all of us who are looking for a home equity line of credit. So again, if this is something you've considered, tap into your home's equity, withdraw the money as needed, essentially have rainy day money. You probably want to go ahead and apply for that right now as quickly as possible, because banks are expected to slowly close down that capability, at least for a short period of time. This has never before happened. It's happening because banks are trying to conserve their cash, because they anticipate a lot of people will be rushing for this. So all we have to do is try and apply for it if you don't have it already. And once you get it, hold on to it and keep an eye on your fees and your interest rate. So once again, if you're considering a home equity line of credit, you want to apply right away, because JP Morgan Chase and Wells Fargo temporarily halted applications in April. There's a chance that other banks might follow. So you don't want to be stuck trying to access your home's equity. So you want to apply right away if that's something you've considered doing. So speaking of accessing your home's equity and speaking of mortgage bailouts are getting out of control and is putting a lot of strain on our financial system. I gave you some numbers at the start of this training, but what's really interesting is that this whole CARES Act, the CARES Act that introduced the mortgage forbearance program, allows individuals to delay up to a year's worth of payments. Now, the key word that I used there was delay. You still have to catch up on those payments. So those payments have to be made up later through either repayment plans or mortgage modifications or a lump sum payment at one time, which is going to be hard for most of us. Government-backed loans make up 3/4 of the current mortgage market, and for borrowers without those loans, in other words, borrowers who went to banks and private lenders, they are also starting to offer forbearance programs. They have to, because individuals are finding it hard to pay rent. Now, here's the interesting thing. While borrowers can delay payments, the servicers of those loans, they still have to make the interest and the principal payments to the bond holders of that loan. And by some estimates, that's $3 billion per month in payment. Essentially, even though the money is not coming in, the servicers of those loans in mortgage-backed securities are still expected to pay the interest and principal payments to the bondholder. So you can try and understand how complex this is and how much it sort of brings everyone to their breaking point, essentially. And finally, I want to talk about what is potentially a big shift in behavior for a lot of individuals. Generally, there's been a preference, especially amongst millennials, for dense urban areas where, there's a lot of public transport, where there's a lot of commuting going on, where you have small, compact places. Now, in the middle of this lockdown, a lot of individuals are actually starting to reevaluate their options. There seems to be a trend away from dense urban areas towards rural areas with a little bit more space. Now, what's happening is a lot of builders are starting to build communities where you have grocery stores, where you have retail stores, which now becomes more attractive compared to living in a dense urban area. A lot of individuals are starting to prefer these new constructions, these urban areas, and a lot of it has to do with the fact that, number one, there's a concern, what if there's another lockdown? Number two, if you have children, you want more room for the children to be able to run around and play. Number three, you want more room for a home office You may want a separate room for a home office, which becomes harder to do in a dense urban area. You may want a separate storage space for yourself. You may want extra room. You may want to avoid commuting. You might say, hey, I don't want to be in a train. I don't want to be in a compact area. I'd rather just work from home. I'd rather do video conferencing, and I'd rather commute less. And also, what's happening, here's another big factor. Because gas is so cheap right now, because it's because the gas prices have fallen so much, individuals don't mind commuting as much, commuting from, let's say, away from work and then going to a suburban home where you have a larger space, where you have a backyard, where you have an extra room of your own for your home office, and where you have, where you don't have to struggle with parking. So this trend, if you will, about moving away from dense urban areas towards essentially suburban areas is actually beginning, especially among millennials. And if you really think about it, this lockdown has changed behavior, because a lot of us are thinking, hey, I probably need to reimagine how I do a few things. I probably don't want to be in crowded areas as much. I don't want to be in a crowded train, in a crowded bus, in a crowded elevator, no less. I'd rather just have my space. I'd rather have more room. I'd rather set up a comfortable workplace. And I also don't want my kids to be close to other individuals and who might get sick. And again, like I mentioned, if there is an extended shutdown, or for that matter, if there's a second shutdown, let's hope that doesn't happen. But if that happens, then the preference is to have more room, is to have more, essentially, is to have easier social distancing, if you will. And that's why this trend, this preference towards suburban areas is starting to emerge. And I personally think it's going to be a trend that becomes more and more, and we might find individuals actually not preferring cities and starting to prefer more suburban areas as we emerge from this, and as we essentially have America 2.0, if you will. I'm basically talking about people's attitudes towards long commute times changing, people's fundamental attitudes towards work changing. We could have potentially an environment in which individuals essentially work many days a week from home and then come into the office maybe 1 or 2 times a week. Will this be a temporary change, or will it be a permanent change? It's uncertain at this point in time, and only time will tell. But I can tell you one thing for sure. Individuals are going to want to reevaluate not only how they live, but where they live. So I hope this video training was beneficial. Please click the like button. Please click the subscribe button. Please smash the notification button. If you are a member of our community, thank you so much for watching. If you're not a member of our community, please consider clicking the like, the subscribe button, because it really helps out the YouTube algorithm. And go ahead and comment below. I look forward to interacting with all of you. I appreciate you watching, and I'll talk to you soon. Thanks.